Good afternoon, everybody. Welcome to your Thursday edition of the TraderMerlin Show. We're going to have a fun one today. I've got a guest on the program, so we're going to talk about bond markets. Overall, when we look at what happened out there in our markets today, the bonds weren't the most exciting. But over the past couple of weeks, we've had a ton of changes with regards to the bond market and central bankers around the world raising their interest rates, even things like the Swiss National Bank jumping 50 basis points, which caught a lot of people off guard there. So we'll dive into that. And of course, later on, we'll look at listener questions and chat and all that type of stuff. So I'm going to start things off very quickly with the topic du jour, which is just bond market changes. Our guest today is a familiar one to everybody out there, and that is Mr. Bill Addiss. Bill, how you doing?
Merlin, great to talk to you, but I must have misunderstood you in the beginning. Did you say bonds were not the most exciting thing in the market?
Well, they're always the most exciting. For you, they're always the most exciting thing in the world. Today wasn't that big of a deal. Come on.
No. What's 12 basis points every day back and forth? A little volatility. That's what we like, right?
Yeah, I almost said it sarcastically because if you look at the, here's the yield for the 10-year today, you guys can see you had a pretty wild swing. The last 2 days for the 10-year have been nuts, going from about 3.3% all the way down to roughly 3%. Very close. So a wild one out there. Before we dive into all that, let's maybe take a step back and see what the big picture looks like. Of course, Wednesday, a week ago, we had Jerome Powell. Kind of surprised some in the last minute because the week before that, it was 50 basis points, solid, no big deal. At the Fed meeting before that, they asked him, 75 basis points? He says, not even an option, not even thinking about it. And all of a sudden, we get 75 basis points. So what's your take on what that means or what that signals to the economy and to the markets overall?
Yeah, no, great question, Merlin, and thanks for having me on. It's great talking to you and everybody out there. It kind of illustrates the point that Powell has been trying to say all along, that any forecasts in this market have to be data determinant. Because, I keep saying it, and everyone keeps saying it, we're literally in unprecedented territory here. There is no rule book here. It has nothing been equivalent to what we've gone through. So, you're right, absolutely right. When you go to the last FOMC meeting, not the one just last week, the first question that Powell got during the Q&A was from Steve Leeson. And he said, what's the chance of a 75 basis point hike? And exactly as you said, absolutely, we're not even considering it. And then 8 weeks later, we got a 75 basis point hike. Why? Because of that CPI number the week before. CPI came out at a higher level than even expected. We were already looking for a level at the highest level in 40 years, and it came out even higher. And I really do believe the Fed is reacting to that data. They've said we're going to be data determinant, which is why, I think almost for the Fed to be making any long-range forecasts is, it might give you a sentiment as to what the Fed is thinking, but nobody should hang their hat on it. We could get numbers, as this shows, that could not change the direction, but change the emphasis. The Fed was already going to hike. It wasn't like this was a policy change. It was a nuance, but it was an important nuance.
I think the strange piece for me is it makes us feel like, as an American, and of course I know we got an international crowd here, you can think of your own central bankers as well. It makes us kind of feel warm and fuzzy when they make these statements. And it's supposed to make you go, okay, they've got this, right? These are, we're under control. They're on top of it. And when you hear them, say there's no way we're going to do a 75 basis point, and then all of a sudden it happens literally the last minute, it makes you think, like, oh shit, these guys might not know what they're doing. And I kind of crack up. I'll bring up the CPI numbers for everybody to check out. Here is that recent CPI number that we're talking about. And, you have this 1 point data where for the month of May, it declined significantly. And immediately, the economists and financial world's like, oh, inflation's under control. And I'm thinking,
right, exactly.
It's like I've got a wild forest fire that's engulfing an entire hillside, and like there's one dry spot that's not on fire. And they're like, hey, we've got it under control. Like, no, the hill's still burning, my man. So, yeah, I thought it was kind of surprising.
I agree with you. There's so many aspects of this big picture that I really think are getting long because we tend to focus, hour to hour, minute to minute. But
right.
The decline of GDP, the fact that we're at a negative now already for this quarter. And what scared me about the FOMC meeting was not what they did on the Fed funds rate. And, we'll come back to it maybe in a minute, but, as we expected, they raised a whole bunch of rates.
Right.
It wasn't just the Fed funds rate. That's the most important. But more importantly, their forecasts going forward are almost crazy. I mean, they're just there's no semblance of reality.
And you have a bunch of those that you brought up. Let's jump to those so we can show some of those rates. You sent me a couple charts here. First off, I got the Treasury yield curve. So let's start with the Treasury yield curve, and then we'll move on.
Cool. So this is the yield curve post the FOMC meeting. So, what the Fed did is they raised the short end of the market, the Fed funds rate, the one-day rate, by 75 basis points. So we've seen a rather dramatic rise up in short rates as a result. What you can also see, though, is that long rates are kind of plateauing out. If you look at that yield curve, the 2-year and the 10-year are almost exactly at the same yield. And in fact, the 10-year is lower than the 3, 5, and 7. Mm-hmm. I mean, there's the inverted yield curve that some people are worried about. So, long-term rates have not gone up as short-term rates have it. And I think that's the important discussion. We were talking jokingly that bonds are boring. Well, bonds are anything but boring these days. You look at the volatility. We're getting 10, 15 basis point swings in a day.
Yeah.
And, I know the OTA community loves bonds, but if you look at where some of these bond products are trading, even like the ETFs, which we could talk about, there's a lot of volatility here. And the market is stuck. We know the Fed is going to raise short-term rates. They've told us that. They're going to do it 6 more times.
Right.
But the real question is what's going to happen to long-term interest rates? Right. And that's the battle that's going on in the market, because if you believe, like I do, that inflation is going to continue to be a problem, and unfortunately that's where I am, but that's just one school of thought, then long-term rates are going to go higher. If the Fed really has to get aggressive on QE to curtail inflation, if inflation's the big issue, then long-term rates are going to go higher.
Right.
If, however, we're going into a recession, then long-term rates are going to go lower. I mean, it's just that dramatic. And that's what the market is wrestling with every day as each individual number comes out. Is inflation the most prevalent issue? Rates bump up. Is recession the most prevalent issue? Rates go down. And as a result, we are seeing huge volatility here.
Yeah. I guess I can ask that question. You've been around through a lot of different market times. If you had to, from an economy perspective, look at both of those numbers, I've got an inflation issue or I have a recession issue, which one would you say is the most dangerous to an economy?
Well, I think the issue is I think they're both going to happen. Let me be quite honest with you. The reality is we have never experienced this type of stagflation problem that we now have without the central bank putting us into a recession. I mean, that's just the reality.
Yeah.
Right? Anytime we've had this phenomenon, the whole idea of a soft landing sounds great. But the reality is it's like, trying to thread an elephant through a needle. We've never been able to achieve this soft landing. So my personal opinion is ultimately, yes, we will go into a recession. But I think, unfortunately, inflation is still rearing its ugly head. I'm kind of the camp. The Fed was too late to the party. They held on to that transitory talk too long. And as a result, they're now chasing inflation. And that's dangerous for a central bank. You want to get in front of it.
Yeah, I agree. And, I agree with you. I believe we are well behind the curve with regards to this. I guess the whole interest rate thing is one piece, but I guess the part that really just blows my mind more than anything is just that they continue to buy mortgage-backed securities in one of the most robust housing markets that we've ever seen. It's just like, wait a minute, why are you propping this up,
Yep. I mean, $17 billion they've added to that portfolio. Yeah, I mean, why the Fed is continuing to support the real estate market, mortgage market, by continuing to reinvest mortgage proceeds makes absolutely no sense. And even I'm not a Fed cynic, but on this topic, I kind of am because, you got to remember the Fed is owned by the banks.
Yeah.
The Fed is continuing to bail out the mortgage industry during a great real estate and interest rate environment. And some people look at that cynically, saying, well, they're just helping out their owners.
Well, I mean, that's
maybe that is the answer.
I kind of feel that way. I feel like it's helping themselves out. At some point, they'll get caught. But, it's all great until everything works until it doesn't, right?
Yeah. Well, I also have to be a little bit cynical because, one of the things that concerns me is people talk about the mortgage crisis in the past tense. I hope people are aware that the very business model of mortgage-backed bonds and the mortgage industry that got us into trouble back in '08, nothing has changed.
Yeah.
I mean, there's still subprime mortgages being issued today. I mean, remember good old Countrywide Savings?
Yeah.
They're now owned by Bank America, and they're still underwriting those types of mortgages. I mean, systemically, nothing has changed in the mortgage market. And maybe the Fed is saying, well, if nothing's changed, maybe I guess we do have to keep propping it up. I don't know.
Yeah, absolutely. Well, for those that are wondering, next week, Wednesday the 29th is actually when we get our final GDP number. The advanced and the preliminary GDP numbers were both negative, which means that the final is going to be negative. So it's kind of funny that you had Jerome Powell say this week, oh, well, we might see a recession. No shit, Sherlock. It's going to be the second consecutive quarter. I mean, what is it going to take you?
It's like, has everyone forgotten that the first quarter GDP was negative when we were expecting it to be positive? And then when they did the second revision, it was even more negative?
It's comical.
It's like people are not believing what they're seeing.
It reminds me of like you got a kid everybody in the room wants him to say something, and everybody's standing around and going, say it, and he's just holding his arms going, no, I'm not going to say it, and finally he just goes, okay, we might have a recession. It's like, no, really? Duh.
Well, and you're absolutely right, because that's the piece of the puzzle he added to it this week.
Yep.
As you know, yesterday and today he's doing his semi-annual testimonies in front of the Senate, and he yesterday uttered that dreaded R word of recession. And, kind of is acknowledging that this soft landing is going to be problematic, to say the least.
Yeah, but, I mean, let's put yourself in their shoes for a second. I mean, if I'm somebody in arguably one of the most powerful financial positions in the world, do you think that there's any chance in hell that I'm going to go out and in my Senate subcommittee hearing and be like, thank you for having me today, senators. It's really an honor to be here. I got to say, we are absolutely screwed. I mean, you might as well move to another country because we're effed up over here. We made a huge mistake. We should not have done what we did. And if I were you, I would probably fire me and press criminal charges. He's not going to say anything like that. He's going to say, yeah, well, maybe. We tried our best, and we'll see how this all unfolds. But it's going to be wild for the next few months, that's for sure.
It absolutely is.
Let's see. Joe asked a good question here, and this is one I think we've addressed in the past, but it is important. It says, Merlin and Bill, which is worse for the average American, the sickness or the cure to inflation?
That's a great question. And, honestly, I have to say the cure can be as bad as the disease short term.
Yeah.
But long term, you hopefully enjoy the benefits of a full treatment. The impact of recession resulting from stagflation is horrible.
Yeah.
We know that. But unfortunately, it is a necessary evil to survive. And I say that, and I'm not being as facetious as it sounds. We go back to Paul Volcker, right? When Volcker had that stagflation issue in the 1980s, and he had the courage to literally turn the economy down into a recession. They raised the Fed funds rate by 700 basis points to kill the economy. And, that was horrible. But to quote Warren Buffett, and I quote him too often on this, he feels that to every corporation that survived 1970, they should elect a statue to Paul Volcker in the lobby, and every employee should give a nod of thanks on their way into work, because it's only through his efforts did we potentially save the U.S. economy. So there's huge short-term pain. Unfortunately, the goal is long-term gain.
Yeah. Oh, that's wild. Let's go. I want to bring up more of your charts here so I can get through those, because you had a whole bunch. So here's the FOMC announcement page, and you mentioned that a lot of things were raised, and I think that this is very important. Start me at the top there, because most people just think the Fed funds rate. Okay, we raised that 75 basis points. Okay. It was a lot more than that.
And Good question. And that is the most important. That's the one the press focuses on when they talk about, rate day. It is the most important. And as we talk about, the Fed funds rate is the interbank rate. It's the rate that banks borrow from each other. And that was the rate that was the 75 basis point hike. So it's now, they've established a range between 1.5 and 1 3/4 for this short-term interest rate to trade at.
And just so everybody knows, that used to be between 0 and 1/4.
I'm sorry.
And just so everybody knows, just until going back into January, that was 0 to 1/4. So
exactly. And for 2 years it was 0 during the pandemic.
Right.
They brought the Fed funds rate down to 0 right at the start of the pandemic in March of 2020. It stayed at 0 during the entire pandemic, and it's only been in the last 3 months. And here we are already up at 1.5%. I mean, this is some of the most aggressive rate hikes we've seen in decades.
Right. And it's not done. Yeah. They've telegraphed we're going to see much more. So walk me. We've got the Fed funds rate increased. Walk us through the discount and then the IRB and repo.
The discount rate is the rate that banks can borrow from the Fed. The Fed is the lender of last resort. This is how we get our safety of our banking system. If a bank has trouble, they can always borrow directly from the Fed. And then they're borrowing at the discount rate. And they just raised that also by 75 basis points. So now if banks need cash, they can get borrowed at 1.75% directly from the Fed. And this is why I say it all the time. I often get the question as a former officer of Lehman, why didn't the Fed bail out Lehman? Well, Lehman wasn't a bank. The Fed had no authority over broker dealers. If Lehman would have been a bank, they could have gone to the Fed to borrow the money they needed. This is why Goldman and Morgan each became banks right after Lehman went under, so that they have access to this capital. So this is kind of an afterthought, but it's actually become fairly important in the financial insecurities of our system.
Totally is.
Only banks get bailed out by the Fed.
I was going to say that's an interesting comment, because if you look what's going on in crypto right now, what you're having is digital asset lenders are now basically the same thing that banks could potentially have, which is a shortfall. They're having struggles. They need capital to keep things going. They have it because of the Fed. With the digital world, you have Celsius and BlockFi and Voyager all of a sudden having some issues with shortfalls of capital. They have nobody to go to. So again, you look at regulatory stuff stepping in. At some point, maybe this is a Fed-backed thing, and now all of a sudden we have protection for digital assets. But that's why you're seeing it implode, is it doesn't have this, honeypot that just keeps on giving you money every time you need it. No worries, you could totally screw up. We got you covered, and if we don't have it, we'll just print more.
Yeah. Well, or they'll arrange a sale. Just to be fair, if a bank's really in trouble, they'll actually lend capital to keep it running, but they'll arrange a sale.
All right, I can't be too evil for the banks.
Yeah. And then the last one is the one that people probably don't understand, and this kind of irks me, but I understand the need for it. They realize the Fed is trying to pull cash out of our economy, right? That's what quantitative easing is all about. Quantitative tapering, rather, is all about, is trying to pull money out of the economy. So they've recently, in last week, raised the rates that they will pay banks to do nothing with their money. And this is going to irk some of your listeners, I'm sure. I mean, again, recognizing that the Fed is owned by the banks, the Fed then turns it around and is paying the banks 1.65% to literally do nothing with their money. Just keep it on deposit at the Fed.
And this is an important piece, though. I mean, it really is important, because what the Fed is saying is that, look, we want you to build yourself a safety net. And in order for you to make sure you have cash on hand, should you get a run on the bank or something like that, you're starting to build up those numbers. Because as of this moment, if I'm not mistaken, Bill, the reserve requirement right now for banks is still zero. It was zero before for the pandemic, but that number should not be zero. That means the bank can lend out everything they have, and that is a systemic vulnerability, in my opinion.
I absolutely agree with you. I think the fact that we went to the banks not having to keep any money on deposit at the Fed during the pandemic, required to. They have, but it's voluntary thanks to things like this. But I agree with you. At a time when the banking system could have been most vulnerable, for us to lessen the credit requirements on the banks, I thought was a horrible statement.
Yeah, absolutely.
Yep.
And our last,
now, they're offering such an attractive rate of return. The banks are keeping, as of last night, it was over $2 trillion.
Yeah.
They're keeping on deposit at the Fed, just sitting there gathering dust and earning them 1.65%.
Yeah, well, which is good for the banks. And then the reverse repo rate has jumped significantly, 25 basis points.
Yes, and that's the rate that, the interest on reserve balance is the interest rate that's only available to banks. But the Fed also, in an effort to suck money out of the economy, has been doing these repos we talked about, where they're basically saying to the banks, we've got these treasuries, we'll lend you to them as collateral if you want to lend us money. And again, that rate went up by 75 basis points. So we're now pulling about $2.5 trillion a night into that product from the Fed. So the Fed is actually doing a pretty effective job through these mechanisms of pulling cash out of the economy. I mean, I got to give them credit on that. Yeah. It's kind of boring and mundane and people don't realize it, but we got $4.5 trillion every night being sucked out of the economy through these two interventions.
And, for those who might be new, I know we've got mostly regulars here to watch this show, but there's really three main mechanisms that the Fed can do to control inflation, or at least attempt to control inflation. Number one is raise rates, which they're doing. Number two would be to pull money supply out of the economy, which they're doing by selling bonds and also some of these other actions. And the third is raise those reserve requirements, which in essence is similar to what the interest on reserve balances is encouraging banks to keep more money on hand as opposed to lend it all out. Lending it out stimulates the markets. Reining it in and not lending it out contracts those markets a little bit, which in turn contracts spending and therefore fighting inflation. But that also will have an impact at some point on economic growth. So we'll see when those numbers start to hit.
That was a perfect recap, Merlin. You know your stuff. Very good.
I learned from you, man. I learned from you. I give all the props to you. Okay, so now let's talk about the future, because you mentioned at the top that we don't really know whether we can trust the statements. They're guessing to some extent too. They have a bunch of data and expectations about where the markets may go. You have on the screen here a few FOMC forecasts. Run us through those.
Yeah, and this is where, honestly, I was a little depressed when Powell started talking. Again, the announcement we got was exactly what we expected, totally. So there was no surprise there. But unfortunately, as Chairman Powell then started talking and getting into the blue dots and what their estimates are, they're lessening, but it's almost joke. Let me illustrate. So the GDP we just talked about was down 1.5% for the first quarter. So the Fed has cut their estimate for the year down to 1.7%. Now, just last meeting, they had it at 2.8% for the year. And the meeting before that, we were at 4%. So they have literally cut their GDP estimates in half from where it was just 16 weeks ago. And even at 1.7, I have to say, that's a pretty optimistic number. If you look at the fact that the first two quarters are going to be negative, you got to get some pretty high numbers to get to, over 1.5% for the second half of the year.
Yeah.
So they've cut them nicely, but the reality is the targets still look way high, and the same is true for inflation. Mm-hmm. They've raised their inflation estimates to 5.2%. Well, here we are in June. We've already been running at 8% for the year.
Yeah.
For us to get to 5%, we got to get inflation down to like 3% for the rest of the year.
I'm going to go out on a limb and say not a chance. I'm
with you on that. I won't take that. I won't take that bet. I'm on your side. If we can get somebody else to take the other action, I don't see how we could get to a 5.2 inflation. It's just absurd.
Well, I was pulling up the Fed Funds futures here, which I'll share with the viewers out at home. Let me share this one for you guys. Unfortunately, you can't see this one, Bill, but just right now they're expecting there's a 40% chance that we'll be up to 3.75 at the December meeting. A 13% chance we'll be at 4%. Guys, just so you understand, that's over double where the Fed funds rate is at right now, which obviously could have a significant impact on loans and that 30-year fixed rate mortgage. So, we may look back in a year and look at the 30-year fixed rate mortgage and, man, I wish I locked in at 6%.
Yeah. Hey, again, I go back to stagflation of 1980 and the 18% mortgage. So those of us with memories remember that. So yes. 6% is still cheap money in the scheme of things. Not for the last 20 years, but in this broader spectrum, still going to be cheap money.
Let's look at something we don't normally look at. Is we check out the bond markets, of course, but I know you've been talking in your Bond Aid program at Online Trading Academy about the different ETF products that might give one access to the market. So I thought maybe you could give us some insights into maybe a couple of different ETFs, what those might look like, and kind of how these rate changes are impacting those.
Cool. Thank you. And thank you. And you probably have that slide up, the two-celled slide.
I do.
Yeah, because when I talk with the OTA community, I tend to always talk yield. I talk about the 10-year yield yielding this and 10-year treasury yielding this or that. But your audience is used to trading price. That's what they look at. So what I took two ETFs, and that I know we get a lot of questions about at OTA. And the one is an ETF that replicates the 7 to 10-year treasury, and that's the TLT. And then we've also comparing it to another 20-year treasury ETF that is the TLT. So we've got IEF. Oh, wait a minute. No, we've got IEF is 7 to 10 years.
Yes,
slide. Yeah, IEF is 7 to 10 years. TLT is 20 years. So if you look at this yield curve on the left-hand side of this chart, what you'll see is when you compare the interest rates this year versus the year before, the blue line today versus the gray line, you can see that interest rates have gone up at both the 7 to 10-year area and the 20-year area. So when yields are going up, that means prices are going down. So let's look at this TLT, which is the 20-year treasury. See, here's the problem for the OTA audience if they want to trade bonds. Bonds are very illiquid because bonds are over the counter. So when we do the Bond Aid class, I really do advocate that if you want to trade interest rates, you might want to look at the ETFs or even options on the ETFs, because ETFs constructed of bonds are much more liquid than the bonds themselves. So let's look at this TLT. That's looking out at 20-year treasuries. And you can see year over year, interest rates long term have gone higher. That means prices have gone down. And look at this volatility, all right? That TLT, when you equate that change in interest rates that we're graphing on the left, when you equate it to the actual dollar price of this TLT, it's down by 25% just so far this year. I mean, in 6 months, we've had a 25% deterioration in the price of the TLT as interest rates are going up. And as I've expressed to you, I personally think that interest rates are going to continue to go up, which is to say the yield prices are going to continue to go down. But if you think we're going into a recession and yields are going to go back down to where they were, this could be potential upside if that's your conviction. In other words, I'm trying to show you that these changes in yields that I talk about really do substantially change price. I mean, if the stock market were down by 25%, kind of as it is, people are talking about a bear market correction. Yep. And here's the bonds are down 25%, and nobody's really talking about corrections. They're just talking about the continued rise in interest rates.
Yeah, actually more than 25%. Right now I'm looking at that TLT on the weekly off from the peak is down. It looks to be right where we're at about now, roughly 36%.
Yeah. So, people, again, you jokingly started the session by saying, bonds are boring and dull. Respectfully, I think this is showing they're not. Yeah. Now, the IEF is a portfolio of 7 to 10-year bonds. That actually is less volatile. And even though interest rates have gone up, you actually have not had as much price deterioration. And that's actually indicating a concept called duration, which we don't have time to get into here. But bottom line, the longer your portfolio is, the more volatile it's going to be. And that's exactly what these returns are showing.
And I think that's normal. I mean, the longer you invest in something, and whatever it's a business proposition, you should get a greater rate of return, greater yield. So that's obviously going to have wilder fluctuations. And the TLT being 20 years, the IEF is 7 to 10. You're rating. We could go into SHY and see much lower volatility. Let's go SHY just for fun. See if I'm talking out.
That's the high yield.
No, SHY is the 1 to 3 year treasuries.
Oh, okay. I'm sorry. No,
JNK is the high yield. Yeah, gotcha. So if you look at
that
SHY,
would get an even shorter duration,
right,
and you're going to have less price of depreciation as a result. Even though interest rates are going up, you're going to have less volatility, less price deterioration on that.
Yeah, falling 5%. That one's down 5%, where the other ones are down substantially more. You want to look at corporate, look at JNK. Now you're really talking, but that's not a duration piece. That's just quality.
Exactly.
Very different.
The JNK portfolio has a lot of credit risk to it.
Yeah,
there are junk bonds in there, but it actually has a very low duration, as I remember. It's got a duration of less than 4. So you don't actually have a lot of interest rate risk in that portfolio, but you have a lot of credit risk.
Right. Bill, good question come in from Rob here. Rob says, approximately how long does it take for CD rates to benefit from the overnight Fed funds rate moving? Right. Obviously, you would think that if these rates are rising, then there's going to be some incentive for banks to offer a little bit more to get deposits in.
Yeah, no, that is a great question. And what I would say is, unfortunately, you're doing a little bit of an apples to oranges comparison. Because remember, on this chart, you can go back to the original yield curve chart. The Fed, when they're raising interest rates, they're literally just raising the one-day interest rate. So the impact to other interest rates further along the curve get more muted the further you go out. I mean, literally, there's virtually no correlation between what affects 30-year interest rates versus what affects the one-day interest rate. So, but by the Fed bringing up the one-day interest rate, they are most affecting the short end of the curve. So the reality is you're already starting to see this. Money market funds, most of us sweep our brokerage accounts into a money market fund to try and get some rate of interest, although there hasn't been any for years. Money market funds are starting to pay you a rate of interest again because they invest in very short-term instruments that have been most affected by what the Fed did. So if you're looking at a 1-year CD or a 2-year CD, the general bias is these rates are going up, but they're not going up as much as the Fed is bringing in the one-day interest rate. So the answer to that question is what's going to happen to the yield curve? But I literally say if you're comparing a 2-year CD with the overnight Fed funds rate, you're kind of doing a bit of an apples to oranges comparison. Again, I'm not saying there isn't going to be a dragging effect, but don't look for a direct correlation. And the other problem you've got right now is the banks are flush with cash, right? We've just expressed the banks are giving money to the Fed because they have nothing to do with it. The banks don't need your money now. And, banks offer attractive CD rates when there's a cash shortage. Well, the banks are swimming in cash now, so they don't need to pay you a high rate of interest to borrow your money.
Well, they may be in a cash surplus, but boy,
Oh yeah, we know this situation's change, right? What is the case today might not be the case in 6 months when the Fed's done burning all this cash and doing what they're doing. That's to say we might not get into a shortage. But right now, CD rates are horrible.
Mm-hmm. Yeah, definitely no incentive to put your money in those bad boys.
Exactly. However, I'd be remiss if I didn't throw in a plug, if you don't mind.
Of course, throwing
because
plugs.
I'm still banging the drum on these I bonds. We've talked about these bonds that are linked to inflation. And we've just been talking about the last 2 months, the inflation rates are going even higher than expected. Well, as you've been done a great job of marketing and getting the word out there. These I bonds for the last 6 months have offered a 9.62% rate of return, government backed.
Hoorah!
And inflation is still going higher. And the next reset is going to be November 1st. We're already 2 months into it. So I continue to love the rates of return that you're getting government backed on these I bonds. We're turning inflation into a positive.
Yeah. Right. If you can't beat them, join them, right?
Exactly. Normally inflation is a tax. This turns inflation into a positive. So, it bothers me that nobody on TV is still talking about these bonds because there's no profit opportunity for money managers and broker dealers because they can't mark it up. They can't trade it.
Right. Well, that's why we bring you on.
That's why you're here. Thank you.
That's right. No, you know what? I think it's important because most people don't talk about this stuff. It's interesting because if I look back into my education, I guess go back to college and all that stuff, I knew what bonds were. Obviously, I knew what a bond product was, but never really the magnitude and impact that it has on the overall economy. I mean, a lot of people think, oh, well, the stock market drives the economy. No, it's currencies and bonds, and these are so much bigger than our equity markets, and I just never knew it. So I thank you for the education you've given me over the years. And speaking of giving education, you have some gratuitous plugs here. You got a 3 set of books. I've read these books.
Yeah,
they're great.
I've had to go multimedia here, so let me put in the shameless plugs for just a moment. First off, for the OTA community, I'm doing a monthly XLT, so the next one will be on July 19th. We just booked that, so we'll be talking more about that as we get closer. So that's kind of a monthly commitment going on. The other thing that I've tried to do over the COVID here is put together a YouTube library. I'm working with a video producer, so I've given the link to the website. There you can get my YouTube library, and there's a couple on the Fed. There's one on the I bonds along with a primer to help explain it. So there's that. And the book offer, I don't know if you remember, Merlin, but during the COVID 2 years ago, I was trying to get these books out to students that were taking introductory classes with me. And we offered it out to the OTA community 2 years ago with even a coupon code of Merlin.
There you go.
But I've been doing it every summer for the last 3. You started it off for me. We've been doing it every summer. So this is a 3-book series that was put together by Stuart Veal, and it was published by Prentice Hall. Stu's the author of the leading textbook in America called Stocks, Bonds, Options, and Futures. Some of your participants, audience members, are probably cringing when they hear the title. It was a textbook.
Yeah, it's got a nice ring to it.
Yeah, exactly. But he came out with this 3-book series, and Prentice Hall hired me to edit it. I'm actually doing a lot more publishing and editing. I'm working on editing one of the Dummy Series books right now.
Wow.
But Prentice Hall hired me to edit this series, and as a result, I took my fee in books. So I'm just passing it on to my clients. So you get all 3 books for $25 free shipping, and basically that covers my shipping charges. These books are normally $25 each on Amazon. So there's my shameless plug. And for 2 years, I've been hesitant to mention this, but they were a great resource at an introductory level.
Absolutely.
I think Stu did a real good job here.
No, they're really good. Especially anybody learning those specific asset classes. So there you go. You've got, go to aftraining.co/shop and you get that $25 for the set of 3 books. I know some of you already have that one. So
yeah, we've gotten good feedback from the OTA community. So I figured what the heck, let's continue it.
Yeah, it's good stuff. All right, let's do a little bit more here. Let's add some questions. This is an interesting one from Rob. What's your thoughts on the government servicing the national deficit at higher interest rate costs? I feel like they would never let it get too high because they couldn't afford it. Good question.
Well, they can't control it. The government can't control the cost of borrowing money. When the government has to borrow money, they issue bonds, and those bonds are auctioned off. The market controls the long-term interest rates. The only rate the Fed, and not even the government, the only rate the Fed sets are those one-day interest rates we've just talked about. So no, but I think more to the point, and Rob is exactly right. This scares the heck out of me.
Yeah.
Because the reality is, since the pandemic, we are borrowing money at unprecedented levels, right? We had a $3.4 trillion deficit 2 years ago, 3.1 last year. We'll see where this year comes in. But we're borrowing unprecedented amounts of money because our elected officials continue to overspend. The good news is, at least for the last 2 years, we've been borrowing money at unprecedentedly low interest rates.
Right.
I hate the fact the government has to borrow so much money, but at least we're borrowing money for 30 years and only paying 3%. To Rob's point, what's going to happen is these interest rates start going higher. And I keep mentioning as a benchmark, and by the way, with interest rates as low as they are, interest on our debt is the government's third largest expense. Mm-hmm. With interest rates as low as they are. What's going to happen if these rates go higher? Let's face it, Congress isn't going to balance the budget. We're going to continue to overspend. We're going to continue to have to borrow, but we're going to have to borrow at higher and higher rates. And I use this as my benchmark all the time to remind people what stagflation looks like. In 1979, the U.S. government issued a 30-year bond right in the middle of that stagflation problem, and they had to pay a 14% coupon to attract investors. The U.S. government paid 14% to those investors all the way through 2009 when that bond finally matured. 14% government backed. Now the government is refinancing that at 3%. That's great. Mm-hmm. But what happens if those rates go higher? Right. It's a budget buster. It's truly a budget buster.
It is. And then the question brings up the old default question for the U.S. debt. I know some of you guys can't see this at home. There's a great site I love. It's called the usdebtclock.org. It's just, it makes you cringe.
Depressing the group.
It really is depressing. Right now we have debt per person in the United States, $91,000 in debt per person. And here I am thinking I'm doing great with my debt, but the government has debt on me.
Right.
To put into perspective, the federal debt to GDP ratio, which is in the upper left-hand box, in 1960 it was 52.75%. 20 years later, it had dropped to 34%, which obviously doing an improvement, right? You jump forward 20 years to 2000, we're back to 57%. And in the last 20 years, we've gone from 57% to 129.5% debt to GDP, a level we've never seen in the U.S. This is not good. It's not good to be in that much debt. And again, Bill's point is perfect. If you can't service the debt, then you have problems with your creditors. And our creditors are China and European Union and Japan and Russia. You have all kinds of other countries out there, and if you default on it, we no longer would maintain any semblance of a superpower in anybody's eyes. So who knows where this is all going to be in a few years.
Yeah, but it is the inability of our elected officials to deal with this deficit problem is what caused treasuries to get downgraded to AA by Fitch back in 2009.
Yep.
That situation has only gotten worse. Where's the rating agencies now? Treasury should not be AAA. That's the reality.
Margaret, a good question. She says, does any country have more debt than the U.S.? I don't think so.
No, we are by far exceed the world, by far. No, in fact, if you take most of the entire world, I don't have the numbers on China because we're not sure of that. But if you look at every other country and put their debt together, excluding China, we're still more than the rest of the world combined. No, we overspend at such an egregious rate that, we have a $24 trillion debt outstanding. That's how much money we have borrowed and have issued out in the market. 24 trillion. I think the closest country to us is like 4 trillion. No, we do a great job of overspending more than the rest of the world.
It's what we're good at.
It's what we're good at. And just to make sure, because, we talk about printing money. If I could just throw in a quick clarification. When the government incurs debts, that's money that has to be paid. Those are real bills.
Right.
And we don't have the money to pay it. So we literally have to go out and borrow it. So when the government has a deficit, that's where we have to go out and borrow money. By contrast, the Fed, as I'm always stressing, is not a part of the government. When the Fed wanted to do something like quantitative easing, they had the authority to just print up $3.6 trillion of money to go out and buy all these bonds. So, I need to make, and I continue to make a strong distinction. The government is responsible for fiscal policy, and they're doing a horrible job. That's why we have to borrow so much money. The Fed is responsible for monetary policy, but they literally have the authority to just create and destroy cash as they need to. It's quite a distinction.
Yeah, it is. It's a great power to have. The magic behind the curtain. Joe Frank asked an interesting question. He says, I don't believe the effects of inflation are reversible. Am I wrong? I would say that you're wrong on some things. And I think Tom mentioned down below, when you look at things like, airfare, things that are really impacted by supply and demand. John O'Donnell always says that the cure for a high price is a high price. And if something gets too expensive, you're just going to stop buying it. It will naturally come down. There are some other things like, let's say gold, where gold has a specific cost to extract something out of the ground. Well, that will theoretically be its floor. So some things will come back down. Others will stay high. I'm dumbfounded when I go to restaurants now. I actually went to, there's a place here in Costa Mesa called Taco Mesa. It's a little hole in the wall place. It's kind of a local hangout. And you could go there and get a nice, pretty good sized burrito with all the fixings for like $8. I went there this weekend because I'm like, I want to go have a burrito. It's a cool shop. I'll take you there next time you're in town, Bill. And the burrito was $15. So we've almost done a 100% increase in price. And beans and rice were an extra $2.50. And I just looked at it and I said, okay. And I walked right out. I mean, I'm not going to spend $17.50 for something that cost me, $8 a year ago. And I think that's what will help prices come back down.
I agree with you. So, the demand curve shifts as prices change. But, to his point, though, I also agree, the way we compute inflation, that CPI number, there are 80,000 different data points every month that are priced into that number. And I agree, though, some of those are more resilient and it will stay up versus others. So, it's a huge basket that reflects an awful lot of diversity. But, I agree with the general point. Sometimes you can't put the toothpaste back in the tube, but inflation is a real phenomenon. Inflation turns negative in a recession. So it's an observable phenomenon. So we do know prices can go down.
This is an oddball one, but let's throw it out there since they guys are loving asking questions here. And I'm trying to get to all of them, but we're going to end up running out of time here because I'm not going to do an hour show. Margaret says opinion on the gas tax holiday. So for those who might know, Biden is proposing that we remove the federal tax on gas, which is, I think, 18 cents a gallon going forward. I got to ask you, if my business is already struggling to make its payments and I don't have any money, and one of my major sources of income is taxing gasoline, right, getting that tax revenue, if I all of a sudden say, you know what, we'll give up that. I'm looking at one of my major income streams being removed, and aren't I just putting myself in a worse situation as a business, in this case the government? By putting that 3-month reprieve?
Oh, absolutely. Absolutely. I'll show my hypocrisy here. I do believe that this tax is important because, as you might remember, and it's documentable, the gas tax is specifically dedicated towards road and infrastructure. I mean, we've got a crumbling infrastructure system. We know that. And we're cutting the major source of revenue going into that. So I think it's a very short-term solution to a long-term problem. And I don't mean to be cruel, I'm not sure 18 cents is going to make a lot of difference to people in terms of real consumption changes. So I guess my taxing bias is showing through, but I look at the road projects and constructions. We know we've got a deteriorating system. This is how we get the money to fix the system. The users who ride on the roads use the gas tax to pay for it. I think that kind of makes sense.
Yeah, I think that we should have. I think you keep the gas tax in place. I really don't think it makes that big of a difference. I'll throw a calculator over here. I don't want to cover Bill's face, but if I do 18 cents, 0.18, and I've got a 20-gallon tank, that means on a fill-up I'm saving $3.60. Is that something that's going to help me get out of my dire financial situation? Now, if I'm driving from Northern California to Mexico every day, makes a huge. Truckers might make a big difference on, but for the average person, who cares? It doesn't make that big of a difference. I'm sorry, I might be hypocritical.
No, and I agree with you, and not to get too political, but I felt the same way about the releasing of the strategic reserves. Mm-hmm. The bottom line reality is, and this is not a popular opinion maybe, the president doesn't set the price of oil. Yeah. And what he's trying to do is affect the supply a bit, but it's minimal. You can't really affect the changes. So I think it's just window dressing. I really do. The president's trying to show a responsiveness to something he bottom line can't control.
Right. Yeah. You got to do something to make people feel like you're doing something. And
exactly.
I'm definitely in the camp that says this isn't Biden's fault. This is macroeconomics. I'm pointing the finger. I know you teach for the Fed, but I point the finger at the Fed with the printing of all the money for so long. I just think that that's the major cause for most of our issues that we have today. But maybe they can get us.
I don't disagree.
Maybe they can get us out of it.
Concern.
What else you got? You got anything else fun market-wise?
I think the thing, looking forward, and I always feel like I'm getting kind of depressing. So I do want to look forward with some optimism, and we'll talk about this in July probably. But just like Treasury yields are going higher, so are corporate bond yields. Corporate bonds have been so so unattractive during the pandemic because the credit spread you got was low, the Treasury yields were low. You just couldn't find any value to corporate bonds whatsoever. But the truth is, between Treasury rates coming up and then the credit spreads for corporates also widening, there's actually an argument can be made if you're starting to look for income, might start looking at bonds again. And I haven't been able to say that since the pandemic started. So we'll see. But, the overlay still is, with inflation running at 8%, it's hard to recommend anything yielding less than 8% right now. That's why the only thing I'm stuck with is I bonds.
Yeah. Yeah, and that's a little bit of a risk because with I bonds, obviously you get the reset, and if all of a sudden inflation just tanks and we go, back down to 2% inflation, you're like, oh, all right.
Yep. No, the nature of a floating rate instrument is it could work against you. It's a double-edged sword. That's exactly right.
Absolutely. All right, Bill. So you mentioned that your XLT session is what, July 16th?
July 19th. We're just put it on the calendar. Yep.
All right, everybody, if you are interested, you can sign up for that class. You can talk to your counselor at Online Trading Academy. Of course, most of you are Online Trading Academy graduates, so you know where to go for that one. But, Bill, thank you so much for coming on. I always love when you come on and share us something new. I think most people look kind of one-dimensional at bonds, and you add a lot of dimension to it, so thank you so much.
Thank you, and you really know your stuff. It's a pleasure working with you, Merlin. Thank you. You do a great job.
Thank you. Take care, Bill.
My best to everyone.
All right. Yeah, that was Bill Addiss. You can contact him at a variety of different places. Amherst, well, I had it up there. Let me just bring this piece up 1 second. I'll close that. There's Amherst, aftraining.co. He's got his book offer out there as well. XLT starting on the 19th of July. And, just some great stuff. As you guys can tell by his presentation, his talk track, the guy knows his stuff inside and out. So really great having him on. I'm blessed to have him on, come on once a month, because I'll be honest, I really didn't care about bonds in the past, but now I realize how friggin' important they are. It is really important. Tom, you said something that made me laugh. I luckily had to mute my microphone. Where was that one? Sitting next door to a Taco Mesa? What? Yeah. It's definitely good. I will definitely give Taco Mesa, but I just can't bring myself to buy something when that owner of that business sold that thing for $8 a year ago. You're gouging me. I'm sorry. Do an hour and a half. Sorry, Ryan, can't do that. I actually have to get to some of your listener questions here. Let me just real quickly get to these questions because I want to make sure I keep it under an hour today. I got tons of stuff to do. Les sent a question yesterday talking about investors, going short, and I said, no, most investors don't. And he said, look, like OTA community, traders, they know to go short. He says, trends are down, so many investors might look to go short. The best trading would be during a pullback or correction. Correct. For trades that might last less than a week, are there, I think this is actually the question that you had. Going to your, damn it, Ryan, I didn't ask him your questions. I'm sorry. There's Ryan's questions right there. Son of a biscuit. There's Les's follow-up. My question about simple moving average crossover, I know that they're lagging indicators, but what I'm looking for is the move into a supply zone. I was thinking that the move up into the supply zone might occur after an SMA crossover. Yes. So you're absolutely right. If something's trending up, you're going to have those moving averages both pointing up if it's on an uptrend. Generally, when you use something like, I think you had the 8 and the 21 period moving averages, generally when you have those, that's going to alert you to when you should be getting out of a short and going into a long if the 8 is curling above the 21. If it's rallying up and you're looking for a pullback into a supply zone during a downtrend, and maybe I can draw this, it might be better. It's going to take me too long to get all this stuff rolling here, so I guess I won't be drawing it. But if you're looking for a pullback into a supply zone, using the moving averages, you're late. It'll curl back up and tell you to buy it, but it won't be curling down yet. Really, what's more important would be using the supply zone itself. Now, some of the other pieces that I think would give you a signal faster than a moving average piece would be like stochastics or potentially RSI, but I think stochastics or even Bollinger Bands, because those will alert you to when something is outside or breaching that or outside the upper end of that range. Sorry, I'm trying to do too many things at once here and drive myself crazy. So let me just see if I can draw this real quick for you. So let's say, you've got something that's trending down. Come on, Merlin. This is why I need TJ. TJ, help me. So let's say I got a downtrend. Boom, boom, boom. And you're like, okay, I want to short when it comes back up into this area right here, okay? If it curls like this and price starts to rally back up, right about here is where you're going to see that moving average. Let's call it the 21. Here's your 21 MA, right? That would have been trending down. And then you're going to have an 8 period moving average, which is going to be much more choppy, right? And that may look something like this. And it just starts to hook. So when you get that crossover right there, that might coincide with some point in this area here. So that's kind of a little bit late, in my opinion. What you're saying is, if it gets up to the supply zone, and now we're approaching this, now what? Well, at this point, these moving averages were going to look like this. That's typically how the moving averages, and this is your 20, here's your 8, right? So that's not really going to help you much. If you use something like stochastics, it can tell you that something is an overbought situation. So if I have overbought on stochastics, which would be any reading above 80, that's saying that it's overbought. And again, that does not mean that it needs to go down. But if I have overbought on stochastics into a supply zone, I can start to feel a little bit more confident about that trade. So I'm not sure if I fully got your question there, Les, but that's how I perceive it. Is I wouldn't be using my entries to time getting out of a trade per se, more of getting in if you're looking for that as an indicator. But really the most important thing is the level itself, and I like things like stochastics just because they're easy to read. Bollinger Bands could do the same picture, right? If I have here's the stochastics, so we'll go %K, and I've got my Bollinger Bands are outside, let's say it's plus 105, meaning it's outside of the upper Bollinger Band by 5%. Well, I've got an extremely overbought situation on Bollinger Bands. I've got overbought on stochastics, and it's in supply. Here we go. I'm looking into something that will help. What do I got for you? I drive 96 miles to and from work. Man, see, now for someone like you, Cesar, yeah, it is going to add up, right? For me, I'll ride an electric bike to work. I'm 3 miles door to door, so I don't care. This 18 cents, big deal. But for someone like you, yeah, that absolutely could have a very, very big impact on your day-to-day consumption. I mean, it could save you a couple $100 a month, depending on how much you're driving. Let's see, Bill, which of the bond ETFs would you recommend for bands in the current environment? For bands? Recommend 4 bands in the current environment? I'm not sure I understand what the 4 bands part is. Let's see. Yeah, Caesar, you might want to move closer to work. Margaret, mopeds, forget mopeds, electric bikes. So I'm telling you, I'll hook you guys up with my supplier. All right, excellent. And I don't have it open over here, but I normally have like TradeStation open, which has a great scanner and filter in it. And it's kind of funny, if you use TradeStation, you can add in what's called %B, and it will tell you when anything's outside the upper Bollinger Band or lower Bollinger Band. And I really, really like that one as well. I wonder if I can get it on different platforms. I'll see if I can find it on some other platforms for you. True, believable direction. Living beyond our means. It's the American way. It's sad to say. It really is. To me, it's important to watch your spending. I'm right now. I'm ratcheting down more than ever, simply because I think that we're going to get a little bit worse in our economy. And again, I don't think we're going to implode. If we look at this overall market, I know we didn't look at anything market-wise today, but if we look at this overall market, I don't think we're going to implode and just have a nuclear meltdown. I actually think that this is going to start to slow down the angle, and I think you'll start to see something like this, where it's going to keep drifting lower and lower and lower, but maybe not with the same slope that we saw before. I think a lot of this pessimism is already priced in. I'm seeing, most of the people I know are talking about this market's going lower, and that kind of makes me nervous, right? If the majority of people in the trading world are going, we're going lower, that means we're going higher. And it seems like everybody I talk to says we're going lower and lower. So I'm right now basing my trades and my investments. I did some little bit of options trading again today. I'm kind of anticipating things drifting slowly lower going forward, and that's how I'm positioning myself. Yes, so I didn't purchase. I sold some calls on XLY. It's a position that I have, so I actually sold at the money calls because I think it's actually going to be dropping down in value. So go to XLY. All right, so here's your XLY. I sold the 141s today. I collected a ton of premium. I mean, it was crazy. I did multiple today. I don't remember whether it was $9 or $5. It was like $9 or $5.50. I forgot. I did some on the Qs today too, so it's probably the Qs that I got the best premium on. But I sold at the money calls. The reason for that is I'm going to collect. I think this was like $5.50. So basically what that does, it puts my dollar cost average down here. It's only for the next couple weeks. I think we'll see some choppy sideways action here for the next couple weeks. The only piece that has me really nervous is next week's announcement with regards to GDP. We know what it's going to be. We have the advanced, we have the preliminary. It's all showing negative numbers. I mean, it would be a miracle if GDP came out positive. I just can't see it happening. So, we know what that's going to be. I guess the extent to which GDP is negative next week is going to be the determinant on how volatile that market is going to be. That could really create some big, big waves. I think the guy meant bonds, not bands. Oh, thank you, Michael. You're probably right. So let me go back to that question. Which 4 bonds in the current environment? Well, look, I don't think you have to say it's a specific bond. They're all going to have action. And what I would say is you want to focus on the main ones. TLT is kind of the big daddy out there, right? What's the trend on that? If you believe that interest rates are still going up, then you're going to be looking to short rallies, right? Because this is inverse. We talked about this a few times. The TLT and SHI are going to be inverse of yields. So we got a supply zone up here right around 118 to 120. Great. If bonds rally up to that 120 mark, or TLT anyway, might be a good shorting opportunity. But again, you have to believe that these bonds are going to be trickling lower and lower and lower with regards to premium and yields surging, right? And again, this is going to look fairly inverse. Here's the 10-year. And you can see, to me, this is the perfect uptrend. Higher highs, higher lows, stair stepping up. It looks like a pullback right now into this area of demand right around 3%. My guess is you'll see this thing recover and start bouncing and going back up towards new highs. So TLT is one of the more common ones out there. SHY is one of the lower time frame ones, 1 to 3 year treasuries. That's a pretty popular one. You also have JNK. Now JNK is corporate, so it's gonna be a little bit different here, but those are kind of the 3 main ones. That I look at on a regular basis. Bill mentioned a couple other ones on today's show, which could also be used. That's the IEF. Excuse me. Here's the IEF, which is 7 to 10. So these are just the different maturities. You got SHI is the short term, IEF intermediate, and then TLT be kind of your longer term. So there you go with the 3, and then I added in the JNK as kind of a corporate bond. So hopefully that helps you there. Let's see. Now, does Jeff Manson think we are going lower? I don't know. I have not talked to Jeff in a while. You'll own nothing and love it, right? You'll own nothing and like it. Spalding. Don't be quoting Caddyshack on this show. Come on. You're going to my favorite show. Nice hat. Looks good on you, though. I could do this all day. All right. Let me go into the economic calendar for mañana, and then I'm going to wrap up here. Here's what we have cooking for tomorrow. Not a lot of huge stuff. No, is that right? Yes, this is right. Let me real quickly. I'm pretty sure this is the right one because I'm waiting for a specific announcement. I just for some reason didn't think it was going to be that one. Yeah, it is. Good. I don't know why I thought that this was next week. The new home sales, which again I am extremely excited about. Because you heard Lennar Toll Brothers, KB Homes are all talking about their prices being reduced. They're having to subsidize some of the buyers, maybe give some little bonus mortgage payments to help stimulate demand for new homes. So my guess is this is going to be, is it a pass an hour? Not a chance, Michael. My concern is that this number is going to come out worse than expected, even with the home builders adding some stimulus into it. So I got like 7 seconds left. I got to wrap it up, so I can't give you the satisfaction of an hour show. Hope you enjoyed it. If you did, leave me some comments down below the YouTube videos or email me at TraderMerlin@gmail.com. Tomorrow is a good whiskey day. I'm looking forward to some nice frosty whiskey. Not frosty, but it's going to be ice cold on the rocks tomorrow. I hope you guys have a great trading Friday, and I'll see you then. Take care, everybody.